Hi everyone, it's PJ here. I hope you're doing well. I'm not sure I've got two of these bubbles going, but anyway, maybe that'll fix itself in a second. Um, I wanted to do two things. Can I give you a quick market update, but also just respond to Dean's questions about gold and why I'm buying it right now. And I bought some on Friday. Actually, I was up quite late Friday night. I had a couple of other positions I was trading, so I wanted to see what the market was going to do around those. So I noticed gold had come back, is coming back, or has come back down into a lower part of the risk range that I was looking for it to be at before I bought it. And I thought, you know what, I'm going to go ahead and take a partial position in gold. But in any case, Dean raises an interesting part of an investor's psychology that I wanted to address, and that is that I think the comment that he mentioned was that gold is at one of its highest levels that it's been at in the last 5 years, and that's absolutely correct. It's been gold's high was around $1,920 US an ounce back in, I think, somewhere around April, May, June, or thereabouts of 2011. Actually, no, it might have been even September of 2011. And so we're not even anywhere close to going back to an all-time high, but certainly in the last 5 years or so, gold's now hitting all-time highs compared to, sorry, I shouldn't say all-time highs, highs from the last 5 years. You know what I'm trying to say, I think. And so the point of the investor psychology comment for me is that just because something is seemingly making a high based on its prior price action means absolutely nothing. Because what happened 5 years ago or over the past 5 years is ancient history and doesn't matter anymore. What we need to obviously be looking at is what is the global macro environment today and what is going on today. And so gold is beginning to figure out, if it hasn't already, that the economic environment around the world is a complete shit show, and that the reserve banks of the world are printing money with reckless abandon, and that they are now buying assets as well to support certain portions of the market. So one example of this is the fact that the Fed, and whether this is legal or not is being debated right now, and it may very well be challenged in court. But in any case, the Fed is now buying things like high yield corporate debt and this sort of thing, which has a whole nother unintended consequence, which, let's face it, guys, I mean, right now, we are in a part of the business cycle that is the bad part that no one likes, right? Because it's where you have bankruptcies, where you have high unemployment, where you have deteriorating economic fundamentals, where you have people experiencing a lot of hardship and pain. Basically, you've got the marginal people in society are being more marginalized now. People who were stupid, and I'm going to use that word because it's true, who were stupid and levered themselves up to the hilt, right, to buy property and levered buyouts with companies and things of this nature. They're feeling the pain big time. Assets are being devalued because that's what happens in a recession and depressionary environment. And nobody wants to experience this pain, which is all part of the business cycle. Like, the business cycle is called that for a reason, because you go through periods of expansion and peak, and then it comes off, and hopefully you don't have a severe recession or even a depression, but you have a period of cleansing where the people that were the ridiculously aggressive business people that made the wrong move at the wrong time have to pay the consequence. And so we're at that period right now where the consequences are you go bankrupt, you have to mark down your assets, all this sort of thing. And we have become, unfortunately, somewhat conditioned to the fact that the central banks and governments don't want this to happen because they want everybody to be happy and live in utopia. And it's all roses and unicorns. I mean, it's just stupid, right? And the person on the street knows that this is ridiculous, right? That this stuff, deep down, I think we all know that these things have to happen. And that's where, the full cycle investing strategy, all the things that I do, give us the warning signs to positioning ourselves correctly for these sorts of events, which I have done for the most part for clients. But back to the gold story. So gold, because I got off into a little tangent there, sorry, but this is kind of a market update and an answer to Dean's question both. So what was happening with gold in the last few weeks? Does anyone remember? And it has to do with the V word, right? Not peace sign, but the V word, V, volatility. If you guessed volatility, you were right. Volatility in gold, remember, was off the chart. Not off the chart, but it was pretty darn high. So I'm just going to pull up a quick chart here of gold volatility. Where'd you go, gold volatility? And just show you once again where we were in the last few weeks. So this chart of gold volatility is about 6 weeks. 1, 2, 3, 4, 5. There we go, 6 weeks. So as you can see, gold's volatility, remember what the magic number is for most things? It's not 31 for everything, but for many, many asset classes it is. Gold is one of those. Gold spiked above 31. And what does that mean for those of you keeping score at home? That means an asset class becomes uninvestable. And you have to stay well away from it because remember, cash flows to asset classes that have falling, low and or falling volatility and below a certain level. And commensurately, cash flows to asset classes, that it leaves asset classes that have rising and high volatility because the volatility is what people can't stomach. So what was happening here? Gold's volatility was rising and it's popped above 31 and it stayed there for a few weeks. And in the last 2 weeks, it's come back down below 31, which gives us a bit of a green light. Now, even though that's red on the chart there because gold's value has been coming down, its volatility has been decreasing. So money is starting to flow again towards that asset sector. And if you put gold in context of what's going on around the world, gold's going to have its day again. Gold is going to absolutely rip higher at some point. And I don't know whether I'll still own it when that happens. Who knows, right? I hope so. I really do. Because gold is an asset class that you do want to own in quads 3 and 4, no doubt about it. And especially in quad 3, because the US dollar does really well in quad 4 in gold's price in US dollars. So as the US dollar continues to sort of appreciate and do well, that's a little bit of a handbrake on gold. As soon as the dollar starts to completely shit itself and starts to go down against other currencies, which I can tell you is going to be very hard for it to do for a while, because believe it or not, I still can't even almost get my head around this one, right? But there's a dollar shortage around the world because so much stuff is priced in dollars because the dollar is the world reserve currency. So a lot of people use dollars to trade, to pay their debts, all this stuff, right? So right now there's actually a shortage of dollars, which is one of the reasons why the dollar has been so strong. It's also a reason that gold has not just probably taken off to the upside yet, but it will. It will. And for those of you that have been clients of mine for a long time, you know that in some respects, I started my investment advice journey with you around the gold story, right? And I was a massive gold bug. I pivoted a little bit away from that because I realized that there's a time and a place and a season for every asset class. And so, yes, while the financial system is completely effed, it doesn't mean that gold is going to perform well in every single environment. And this is why I pivoted towards a full cycle investing model, because it helps me hone in on the skill, or have the skill to hone in on when is the right time to own a specific asset class. So anyway, I digress a little bit there. So what's happened this last week is gold's volatility has come down. Gold is in a bull market. It is in a bull market right now, and its price is going to go higher. But it's also going to fluctuate in a risk range, or in a range of price. And that range of price is dependent in large part also on its volatility. So volatility going down, the risk range is going to widen out a little bit. It's going to tighten up a little bit. And we should see, so as volatility lowers, risk range tightens up. So we're going to see gold hopefully just kind of tick higher slowly. But because I don't know exactly what gold's going to do from day to day, I know a range of price that hopefully it will trade within. As it gets down to the lower part of that range, which it did on Friday, I'm going to buy some, which I did. And I didn't buy a full allocation of it. So for those of you that have watched or have heard me talk about asset allocation, or position sizing, I should say, not asset allocation, excuse me, I misspoke, position sizing. The maximum position I would have in GLD, which is gold, would be 10% of a portfolio. That's a maximum position size that I would have on. So I allocated about 4 to 5% in client accounts on Friday. So I still have room to add. I can add another 1% at a time, 2% at a time to get that full 10% allocation on. And then hopefully ride that bucking bronco all the way to $1,900 or $2,000 an ounce. But anyway, that is what's happened with gold. And it also, I suppose, demonstrates how quickly something can shift, right? So if volatility tomorrow, like it isn't going to happen, but if volatility, right, we talk about the VIX a lot. I'll just pull a chart of the VIX up. I talk about the volatility index a lot because it's one of the key volatility indexes. If that dropped to 20 in like a week, that would signal that something's going on in the equity market, and all of a sudden money would be flowing again to the equity market. Now, it's unlikely that that's going to occur. The probability of that is quite low. We're probably at the bottom end of the VIX risk range right now. But 38, even though it is falling, it's not below 31. So that's the magic number that we're looking for. And I still maintain, ladies and gentlemen, I'm just going to put an index of a chart of the SPYs up here, this S&P 500. This is a great chart to look at to see that we've had a bounce, right? So I've talked about this bear market bounce that we're having right now. And so this is the peak. This is back in Feb. Whammo, thank you very much. Just a weekly chart, by the way. Whammo down to the intermediate term low, which we had, which is back in the week of sort of the second last week of March. And we've had a nice little rally. I mean, that's roughly 50% retracement, roughly. Probably a little bit less, but anyway, it's about a 50% retracement of this down move. And the question on everyone's mind is, well, where to from here, right? Is this thing going to just shoot right on back up and give us that V-shaped recovery? Well, probably not. And here's one of the reasons why. I was watching some great stuff. I'm going to see if I can put a link to that in the boardroom. Hedgeye, which is one of the firms, or not one of the firms, that is one of the key firms, I suppose I should say, excuse me, that I use to get my institutional research. Now, I pay for that. I pay handsomely for that. You get the benefit of that. But they have a lot of free stuff. And they put on this investment summit. And there's some really smart people that Keith McCullough, who's the CEO of Hedgeye, interviewed. And a couple of the interviews talked a lot about the banking system, the economy, COVID, and what the cycle is that we could be on here. And so just as I wrap this up, because I did say it's going to be a short market update, one of the issues that is potentially going to hit us, and we're not going to know until we do it, but it is when we, quote unquote, reopen the economy and people will go back to work and people, get back to maybe a more normal, not the social distancing thing and all that, but just, get back to some sort of form of normality. Are we going to see a resurgence of COVID-19 cases? Now, the answer is, I don't know. And the answer is no one really knows. But if you understand, I think it's virology and how viruses are transmitted and this sort of thing, then I would be asking myself, okay, are we going to be able to completely wipe out the virus everywhere? And I think the chance of that is low. Like there'll be somebody with COVID walking around with it. And it's transmitted quite easily, apparently. So there's some metric that's used to map out and model how viruses get transmitted and how many people become infected. If a certain population of people has it, how quickly it'll go to, a certain number of people getting it. So the point I'm making there is, even if it looks like the curve is slowing in Australia and everything's fine and we go back to some normalcy, be prepared to see a resurgence of COVID-19 cases. And we also need to be prepared for another sort of shutdown, the response that the government will have this time to COVID. The final thing I'll say quickly is, do not think for 1 second that the full economic gravity of the shutdown has been priced in and has yet been felt. We have not received the unemployment figures for Australia that really captures this period of time. We had a pretty good number. It was okay. It was a small drop, I think, in employment, but nothing major. But the next one, the April figures, which will be released, I believe, in May, are going to be horrendous. And so there's no doubt, again, in my mind, that we're going to have a recession here in Australia. It could be worse than that. And one of the other key things that came out of some of the talks that I watched over the weekend was people's economic behavior is going to have changed during this crisis. So things like just going out to eat anymore, getting on a plane, all of this stuff, we're going to see some changes. And so we're not going back to where we were pre-COVID. But what that world looks like, we don't know yet. So on that note, I shall leave you to ponder some of those things, but hopefully that answered some questions around gold. There's certainly some really good questions being postulated out there about how this COVID-19 situation changes behavior patterns and changes our economies around the world and shifts them. So I'll be watching that with great interest. Anyway, I hope you're having a good week, staying safe. Got the Anzac weekend coming up. So another long weekend for us. And I will undoubtedly leave an update before the weekend. So have a great week, everyone, and talk to you.